Hi everyone, hope everyone's doing well. Just wanted to do a quick video on interest rates, which is pretty much the talk of the town at the moment in the finance world, but also getting some questions from clients. So when we're talking about interest rates, really we're looking at two things, and that's short-term interest rates and long-term interest rates. On the short end, it's really what the Reserve Bank is setting as the interest rate. At the moment, it's at 0.1%, so historically it's very low. And then for long-term interest rates, we look out to the 10-year bond yields, which are up around 1.7% at the moment on government bonds. Really what this is showing is that the expectation is that rates will go up over time. So we know that, but still getting questions around, how does this affect my portfolio, my assets, where should I put my money? So if we're talking the asset class of property, obviously the property market is going gangbusters at the moment. We're seeing massive rises in prices, and that's due to the low rates. People can get access to money quite cheaply and pay a low rate of interest, which means they can potentially pay more for a property than they usually would be able to. One thing to keep in mind when buying a direct property is that is a direct investment. It's quite large and can be illiquid, meaning that it's not the easiest to just go out and find a buyer if you need to sell it. The current market, I think you'd be fine, but thinking along the lines of this is a long-term investment, so at some point in the future you may need to sell it in a different sort of market that we're seeing today. So just something to keep in mind. Another part of the portfolios is the defensive side. So people, obviously hold cash, term deposits, and fixed interest. So this part of the portfolio is generally for capital preservation and just providing the portfolio a bit of income. The income side of things is quite low due to the low rate environment at the moment. We're seeing anything from 1 to 3%, but we are getting some capital preservation there. The third part, is the growth side of the portfolio. Australian shares, international shares, the equity markets. So what we're seeing is a lot of people pull money out of your defensive style investments and go into more your growth style investments to get that capital growth, but also to get that income yield, because potentially you're not getting enough from the defensive side of the portfolio. But it's just important to know how this sits with you and your risk profile, and whether you're comfortable taking on that extra level of risk for that extra return. On the equity side of things, we see the current environment to be pretty accommodative. The RBA has come out and said they're still going to keep rates low for longer, at least another couple of years, which is good news for markets. We're seeing the reopening of the economies. There's still quite a ways to go, so as we continue to see that, we'll see companies do well in the recovery as well, which will reflect in their stock price. The other positive of holding shares is obviously opposite to property. It is a liquid asset. If you need to buy and sell, there's about a 2-day settlement period. So really at the end of the day, it's about having a mix of all these things, and it is relevant to your personal situation, your risk tolerance, and what your financial goals and objectives are. So I'm happy to have a chat with myself or John if anyone wants to chat further about their particular situation and their investments. Please reach out and we'll have a chat. Thanks.